China is digging in. Americans are waking up to a whole new escalation in the global trade war. Beijing is hiking its retaliatory tariffs on U.S. goods today from 84% to 125%. And for the first time since this all started, we're actually hearing from the Chinese President Xi Jinping himself.
Imagine the world's most critical tech supply chain vanishing overnight. China just shut down ASML and TSMC's access, and now global markets are spiraling. What if this isn't just about tariffs? What if it's the first strike in a silent war that could change everything? The semiconductor war just hit a boiling point. China's unexpected move to restrict ASML and TSMC's access to critical materials has sent shockwaves through global tech markets. Meanwhile, Trump's aggressive tariffs and fiery rhetoric are only fueling the fire. As chip giants falter and stocks nosedive, the question isn't if this will escalate, but how far it'll go. In a bold and highly controversial move on April 2, 2025, President Donald Trump declared a 10% universal tariff on all imports, calling it the beginning of what he described as America's economic liberation.
Look at that. China, first row. China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. So 67%, I think you can, for the most part, see it.
He dubbed April 5th Liberation Day, marking the rollout of this sweeping trade measure. The announcement sent immediate shockwaves through global markets and marked a major escalation in already tense US-China trade relations. Just a week later, on April 9th, the situation intensified dramatically. The Trump administration raised tariffs on Chinese imports to an effective rate of 145%, citing reasons of national security and economic sovereignty. Trump claimed that the U.S. had been taken advantage of for too long, and that this aggressive tariff hike would finally level the playing field. However, the reaction from Beijing was swift and severe. On April 12th, China hit back with its own set of tariffs, imposing a 125% tax on all U.S. goods, a retaliatory move aimed at equalizing the pressure. The impact on American businesses was immediate and far-reaching. Tesla, for example, was forced to suspend shipments of components from China for its highly anticipated Cybercab and semi-electric trucks, throwing off production timelines in Texas and Nevada. David's Bridal, a major U.S. retailer, shifted its manufacturing operations from China to other countries like Sri Lanka and Vietnam to avoid increased costs and supply chain instability. These examples reflect a broader trend as businesses scramble to adapt to an increasingly unpredictable trade environment. The broader economic implications are even more concerning. Companies that rely heavily on Chinese manufacturing are seeing their operational costs spike, which could fuel inflation and slow consumer demand. Economists are warning that prolonged tariff battles could drag down GDP growth, lead to higher unemployment, and severely disrupt global supply chains. Small and mid-sized U.S. manufacturers are particularly vulnerable, many of whom lack the resources to pivot quickly or absorb the rising costs. In response to Washington's escalation, Chinese state media delivered a scathing rebuke, urging the U.S. to stop whining and accept that the age of economic dominance was shifting. The appointment of Li Chenggang as China's new chief trade negotiator also suggests a more strategic and possibly more confrontational approach in future negotiations. With both sides firmly entrenched, the global community is left watching anxiously. The long-term consequences of this trade conflict remain uncertain, but one thing is clear. Neither the U.S. nor China is backing down, and the stakes continue to rise. In a significant escalation of the U.S.-China trade conflict, China has implemented measures that effectively restrict access to critical semiconductor resources, impacting global tech giants like ASML and TSMC. One of China's key retaliatory actions includes halting exports of essential rare earth elements, such as dysprosium and yttrium, which are vital for the production of advanced semiconductors and defense technologies. This move has disrupted supply chains and raised concerns about the availability of these critical materials for U.S. companies. Furthermore, China's approach to tariffs has introduced complexities in the semiconductor industry. The China Semiconductor Industry Association, CSIA, clarified that tariffs would be applied based on the location of wafer fabrication rather than packaging. This means that U.S. chip makers outsourcing manufacturing to facilities like Taiwan's TSMC are exempt from the new tariffs, while companies with U.S.-based fabrication plants, such as Intel and Texas Instruments, face tariffs of 84% or higher. This strategic differentiation has led to market fluctuations. Shares of companies like AMD and NVIDIA, which rely on TSMC for manufacturing, experienced gains, while stocks of domestic manufacturers declined. ASML, the Dutch supplier of advanced lithography equipment, is also affected by the escalating tensions. The company faces challenges due to export restrictions and tariffs, impacting its ability to supply critical machinery to Chinese semiconductor manufacturers. This situation has broader implications for the global semiconductor supply chain, as ASML's equipment is essential for producing cutting-edge chips. The retaliatory measures by China are not only economic but also strategic, aiming to leverage its position in the global supply chain to counter U.S. trade policies. By targeting key materials and technologies, China is asserting its influence and signaling its capacity to disrupt industries heavily reliant on its exports. These developments underscore the interconnectedness of global supply chains and the potential for geopolitical tensions to have far-reaching impacts on technology sectors worldwide. Companies are now reassessing their manufacturing strategies, supply chain dependencies, and market exposures in response to the evolving trade landscape. As the situation continues to unfold, stakeholders across the semiconductor industry are closely monitoring policy changes and preparing for potential disruptions, highlighting the need for strategic resilience in an increasingly complex global market. The escalating trade tensions between the United States and China have profoundly impacted the global semiconductor industry, disrupting supply chains, affecting corporate earnings, and prompting strategic shifts among major players. One of the most immediate effects has been the volatility in global stock markets. On April 16, 2025, European shares declined significantly after ASML, the world's largest supplier of chip-making equipment, warned that U.S. tariffs were clouding its business outlook for 2025 and 2026. ASML's shares dropped 6.5%, dragging down the broader stock's X 600 index by 1.3%. Other semiconductor companies, including ASM International, BE Semiconductor, Soitec, Infineon, and ST Microelectronics, also experienced declines ranging from 2.7% to 4.3%. In the United States, companies like NVIDIA have faced substantial challenges. NVIDIA's stock fell by 5.8% in pre-market trading after the company disclosed a potential $5.5 billion charge due to new restrictions on exporting its H20 chips to China. These chips, initially designed to comply with earlier export regulations, now require special licenses, complicating existing operations and sales to Chinese customers. China's retaliatory measures have further strained the industry. The country has halted exports of critical rare earth elements, such as gallium and germanium, which are essential for semiconductor manufacturing. Several Chinese rare earth sellers have declared force majeure on their contracts, and cargoes awaiting shipment have been barred from leaving ports if they haven't cleared customs. This move has disrupted global supply chains, forcing companies to seek alternative sources for these vital materials. The semiconductor manufacturing equipment market has also been affected. Trump's tariffs have introduced additional costs for equipment sourced from key trading partners, including China, Canada, Mexico, and European countries like the Netherlands. These tariffs impact various equipment categories, such as lithography, deposition, and metrology, with ripple effects across logic, memory, and microprocessing unit production. In response to these challenges, companies are reevaluating their supply chain strategies. NVIDIA, for instance, plans to invest hundreds of billions of dollars in the U.S. supply chain over the next 4 years, shifting production from Asia to mitigate tariff impacts and enhance supply chain resilience. Similarly, TSMC has begun producing advanced 4-nanometer chips for U.S. customers in Arizona, marking a significant step in diversifying its manufacturing footprint. Despite these efforts, the industry's outlook remains uncertain. Analysts warn that the new trade barriers threaten to raise prices and slow demand, casting a shadow over the projected $697 billion revenue for the semiconductor industry in 2025. Capital expenditure and expansion plans are being put on hold as companies navigate the complexities of the current trade environment. In summary, the intensifying US-China trade conflict has disrupted the global semiconductor industry, leading to market volatility, supply chain challenges, and strategic realignments. As companies adapt to this new landscape, the long-term implications for innovation, production, and global competitiveness remain to be seen. The escalating US-China trade war has sent shockwaves through global financial markets, triggering significant volatility and raising concerns about the broader economic outlook. On April 2, 2025, President Donald Trump announced sweeping tariffs, including a 10% universal tariff on all imports and a 145% tariff on Chinese goods. China swiftly retaliated with 125% tariffs on US imports. These actions led to a dramatic sell-off in global stock markets. The Dow Jones Industrial Average plummeted over 4,000 points within 2 days, marking one of the worst declines in its history.
For a moment here, the closing bell on Wall Street ending what has been a very tumultuous 2 days for the stock market. Another day of steep losses here after President Trump announced his sweeping tariffs. Millions of Americans obviously worried about rising prices and about their 401ks already taking a hit in the last 48 hours. Take a look at the closing bell there. The Dow down 2,200 points, closing well below 40,000 there at 38,314.
The S&P 500 and NASDAQ also experienced significant losses, entering bear market territory. Investors, seeking safe havens amid the turmoil, drove gold prices above $3,300 per ounce for the first time. The US dollar weakened against major currencies, and bond yields spiked, reflecting growing concerns about inflation and economic stability. The tariffs have had immediate impacts on various sectors. Boeing, already grappling with safety issues and financial losses, faced a significant blow as China banned imports of its aircraft, opting instead to support domestic manufacturers like Comac. This move not only affects Boeing's bottom line, but also signals China's intent to reduce reliance on US technology. The electric vehicle (EV) industry is also under pressure. The US's dependence on China for critical minerals essential for EV production, such as rare earth elements and graphite, has become a vulnerability. China's export restrictions on these materials threaten to stall the US transition to electric vehicles, despite domestic investments in supply chain development. Economists warn that the mutual imposition of high tariffs effectively amounts to a trade embargo, with both nations suffering economic consequences. US exports to China, valued at approximately $150 billion, are expected to decline sharply, while China's exports to the US, worth around $440 billion, could drop by up to 75% over the next 18 months. These disruptions may tip the US into a mild recession, with indicators such as consumer confidence, inflation, and capital spending flashing warning signs. The broader implications extend beyond the US and China. Global supply chains are being reconfigured as companies seek to mitigate risks associated with the trade war. European and Asian markets have experienced increased volatility, and the uncertainty has led to a cautious approach among investors worldwide. In summary, the intensifying trade conflict between the US and China has disrupted global market-strained international trade relations and posed significant challenges to economic stability. As both nations remain entrenched in their positions, the path to resolution appears uncertain, leaving the global economy vulnerable to prolonged turbulence. Don't just watch history unfold, be part of the conversation. If you found this eye-opening, make sure to like the video, subscribe to the channel, and hit the bell icon so you never miss an update on the global power shift shaping our future.